Good morning, Jags. This is Fahad. Today is Tuesday, October 27th. Today, I want to give a preview of Amazon earnings report, which is coming out on Thursday, October 29th, after market close. Now, let's start off with our third quarter Jaguar outlook right over here, in which here is the article on page 99. This was in the third quarter outlook, in which we recommended buying the November 3,000, 3,500, 4,000 call butterfly spread for $96 or less. And a big bull case was presented with the title, "It's a Jungle Out There on Amazon River," basically discussing in detail that all roads lead to Amazon in this particular environment that we are living in, which is COVID. And since then, many of the JAG clients are still holding that call butterfly spread. It is gradually appreciated, now going for about $136. So it's about 40% or so since we recommended that trade. Still like that structure, but I think there may be other ways of capturing the potential here as well going into this earnings report. But let's talk about exactly what's standing out in front of me. First of all, understand that Amazon option activity has been very, very bullish for quite some time, and particularly in the longer dated call options. So if you go look at the January month, and then if you go look beyond that into well into 2021, you will see there has been some very large block multi-million-dollar contracts that have been accumulated. Many of those we have discussed. They're recorded in the activity tracker as well as in Jaguar Scan, where you can pull all that data. Now, with that said, a couple of things that you need to keep in mind. This quarter is going to shine in many different ways. It's going to be a robust, very, very strong quarter. But there's going to be a little bit problem with the margins, in this quarter. And this is mainly because of timing shift. Let me explain in big picture. The retail side is going to be explosive. Expect the retail sales to be up north of 40% year over year. Some estimates go as high as 44%, and I believe the lowest estimate that I've seen on the street is somewhere around 33% growth on the retail side. And similarly, the AWS component, the cloud component, is also going to be very, very strong, more than 30% growth year over year. But the reason why these very beautiful, strong top line revenue growth might be masked with a little bit of weakness is because margins is going to be a little bit difficult story. There's a couple of reasons for that. Number one, there's going to be first a little bit of a decelerating trend from the second quarter to the third quarter, mainly because second quarter, when everything was shut down, Amazon was a go-to name for all kinds of shopping as people were restocking and all of that. So optically, on a sequential basis, you're going to see some deceleration in trend. And that means some of the economies of scale that the company benefited from is going to reverse. That's the first thing. And the second thing is that AWS likely is going to show a lot of deal signings, but at a lower margin business, and that's generally been the theme that we are seeing. And that means that when new deals are coming and the top line revenue growth for AWS remains strong, but the deal are being priced at a lower level, that is going to also pressure a little bit margin. So it's hard for me to exactly sit here and think about whether the earnings per share or the operating income can extend beyond what the street estimates are, but I believe the top line revenue growth will surprise to the upside. There's another major important thing that you need to keep in mind, and that is this chart right here. Amazon Prime is a very, very important event. You go back to all the way to 2016, and you will find out that 2016, the Prime Day happened on July 12th. On 2017, Prime Day happened on July 10th. 2018, July 16th. 2019, July 15th. But in 2020, it was shifted by the entire quarter. It happened on October 13th. That means it did not benefit the third quarter, but it will benefit the fourth quarter. More importantly, going into this event, the Prime Day, which represents as much as 5% of the company's total annual GMV growth, so it's a pretty significant piece, we found out that the company did significant amount of hiring. Just in the third quarter alone, the company hired 100,000 new full-time employees. In fact, it is now estimated the company actually employs more than 1 million people. Can you believe that? That's how big Amazon is, more than 1 billion people. So there was a 10% increase just in the third quarter alone. On top of that, the company started 100 new fulfillment centers, all in the third quarter. It was actually over the course of entire year. If you look at 2020, the company opened 175 new fulfillment center. Of that, 100 of them happened just in the third quarter. So what does that mean? That means significant amount of capex spending went into the third quarter in hiring and building out the fulfillment center, but the Prime Day benefit did not happen until the fourth quarter. And that's what I mean when I say that the retail side of the margin could potentially be a little bit weak, but the top line revenue growth will be strong. On the positive side of things, on the retail, because the Prime Day happened in the fourth quarter, previously, if you look at the last 5 years, Amazon always has a habit of setting a low bar of expectation for the fourth quarter, for the holiday season. And if I'm looking at this particular time, you will notice that in previous years, when the company has posted about 30% retail sales growth, then they have come out guiding for the fourth quarter retail sales growth that has been normally in the mid-teens percentage. They don't have that incentive this time. They have a reason to this time guide significantly better than what the street estimate, primarily because of the fourth quarter, because of the Prime Day shift. So I expect that the top line revenue guidance for this company could potentially also surprise to the upside, and because of the Prime Day shift. So that's another thing that you need to keep in mind. The third-party sellers on Prime Day was very, very strong. That's another thing you need to keep in mind. For example, if you look at the percentage increase on a year over year, from 2018 to 2019, the third-party sales on Prime Day went from 1.5 billion to 2 billion. That's a percentage increase of about 30%. Roughly, but then from 2019 to 2020, it went from 2 billion to 3.5 billion. That's a 75% increase year over year in the third-party sales. Another reason why I believe that the fourth quarter guidance will likely surprise to the upside. Here's another way of looking at it in terms of total weekly e-commerce growth. This chart comes directly from Bank of America debit and credit card spending data, which is very nice channel checks. We look at them all the time. Take a look at the sharp surge that we saw in October. Once again, it does not benefit the third quarter, it benefits the fourth quarter. Here's another way of looking at it. This comes down to AWS piece. Now look at the top line revenue growth, and you will see this has been gradually decelerating. Each quarter, 41%, 37, 35, 34, 37, and 2019 ended with a 37% growth, then 33 and 29. This is indeed a little bit of a concern, right? Because if this gets down to mid-teens percentage over time, that means that component is going to get hurt. But I believe this growth is still very, very strong. And considering that the third quarter and the fourth quarter saw a little bit of a capex disruption, maybe there's reason to believe that the growth may actually even accelerate from here. But just wanted to point out that there is a decelerating trend that we are seeing in AWS growth rate. Operating income total growth rate has also gradually come down. However, backlog remains quite strong, which is always positive. In fact, in the second quarter of 2020, the year-over-year growth rate in the backlog was up 63%, which was the highest in at least a year and a half. So that is potentially telling us, what I just said, that the quarter is likely going to still surprise to the upside in AWS as well, because they're going to have to work through all of this backlog, which is growing much faster than the top line revenue growth. Remember the quote that I always say, bookings in excess of billings, and that's what it means. And lastly, going back to the retail side, I will point out these are the categories that are the highest growth categories to the lowest growth categories on Amazon website. And you can see that the food delivery and the sporting goods and the electronics, and the groceries, those were the highest, naturally because of the pandemic. But then if you go further down, you will see home furnishing, personal care, clothing, on all of that was on the lower end of the site. Most important thing is this line right here, which is the e-commerce total growth. This is very, very strong. Okay, so yes, it was much stronger in the second quarter. You can see April up 73%, May up 79, and then June up 71, and then gradually decelerated. But I think this will pick up again starting from October because of the Prime Day shift. So I would expect this to basically go higher. So that's the overall view on Amazon. Expect a very strong top line growth. A little bit difficult to see whether margins are going to hold up because the fulfillment centers, 100 of those were open in just Q3, plus they hired 100,000 people in the third quarter. Amazon AWS growth is decelerating, but the backlog is rising, so that's a beautiful outlook on the future. And lastly, I believe that the fourth quarter guidance could come in better than expected. Put it all together, I don't see this stock pulling back at all. I think if it does pull back, it will present a buying opportunity. I think this is a winner, especially for the fourth quarter. So I expect a new breakout to new 52-week high after the company reports earnings. And that's it from me. Jay?
Morning, Pod. So this morning, taking a look at the dental industry, specifically, XRAY, NVST, Patterson Companies, Henry Schein. So last Friday in Jaguar Live, XRAY was brought to our attention, and it's a name we've obviously covered many times before. They do have earnings coming up on November 5th before the open, and we'll definitely be keeping an eye out for channel checks. I know Stifel analyst Jonathan Block, who covers Align Technology, and he's someone that puts out due diligence notes ahead of earnings. So I would expect to see something from him either this week or early next week. But the reason why I'm bringing up the dental industry today is because last week there was a Piper Sandler note talking about how there is a multi-year contract to service Heartland Dental's 1,100 plus office network that is up for grabs. Now, Heartland Dental is the largest dental DSO or dental service organization in the world, with the 1,100 plus offices that I mentioned. And it's also one of the fastest growing platforms with 125 plus new offices being added annually. 4 years ago, Patterson Companies, which is symbol PDCO, they secured this contract with Heartland that went from January 2017 through December 2020. They wound up winning that contract away from Henry Schein. Estimates show that in 2017, that contract was worth approximately $40 to $50 million annually, and the full value now could be closer to 75 million and tracking north of 100 million. And with this contract pretty much in the final few months, new negotiations have started with Patterson and others. So therefore, they are likely in the late stages. Piper even suspects they'll hear of an update on this in the coming weeks. Now, looking across the entire dental landscape, Piper sees 4 potential players involved for this contract. Of course, Patterson, who is the most likely choice and logical choice just because they've done a good job under the current contract with no major issues. You also have Henry Schein, HSIC, Invista, symbol NVST, and then the wild card would be Dentsply Sirona, as they have the benefit of being the largest and most diversified provider of consumables used in the dental office. They rank number 1 in endodontics and number 3 in dental implants. And finally, XRAY CEO Donald Casey has also been vocal about his interest in working more closely with DSOs, even having established a dedicated DSO-focused team over the past couple of years. So just an interesting contract to keep an eye on over the next couple of weeks, as we might get an update on this.
Is there a reason to believe, just your observation, that it will not stay with Patterson Companies when it's renewed? It seems like a pretty big contract, from Heartland, 1,100 offices at the end of this year, up for grabs. But PDCO is already serving this. Is there a reason to believe why they won't stay with the incumbent?
I have not heard or seen anything that would sway them from going with Henry Schein or X-Ray, for example. That's why I kind of emphasize the fact that X-Ray would be a wild card in this.
Yeah, I mean, XRAY, I love this company, Dentsply Sirona, but for a very different reason, which is the Prime Scan
Yeah.
launch that happened more than a year ago, which had a very strong launch and a ramp up for 2 to 3 quarters in 2019, but then COVID happened, and I believe the capex were cut across the board, and as a result, now it should start to gradually come back. It's been my play on that theme for quite some time, and I believe this stock is attempting to break out from a major basing formation and should gradually run all the way back to 56, closed yesterday at 47. But as far as consumable concern, I mean, I could be wrong, but unless we read something else otherwise, I think the logical play here would be to basically own call options in PDCO for potential that it will get renewed again. But again, right, I could be totally wrong about this. And if we discover something else in our research, then there's a reason to go in that direction. Good stuff. Very big contract up for grabs in December. All right, fantastic. Chronicle?
Morning, Fahad. So I've been looking for ideas within the semiconductor space. Specifically, I'm not looking within memory of computing, but I'm not talking about AMD or Micron, but rather I'm more interested in semis that are more exposed to industrial, automotive, and commercial applications for 2 reasons. Number one, manufacturing PMIs have continued to come in relatively stronger than services, and respondents have generally been more optimistic regardless of the pandemic and the political environment. So we can see in the first slide that I shared, the rebound in Chinese manufacturing output and orders has been incredible. Now, we've all seen industrial and construction stocks go up a lot lately, but here's the thing, while these heavy construction and manufacturing stocks have run up, I'm seeing quite a number of semiconductor stocks that are exposed to these themes that haven't gone up as much. And I think this is partly because in today's ETFs and algo-driven world, these industrial semis may have gotten unfairly grouped together with all the other pure data storage and smartphone and hardware stocks. So I think there's going to be some opportunity here for industrial semis to catch up with the other construction stocks. And particularly one such industrial semi that's caught my attention is a company called nLIGHT, symbol LASR. Last time we talked about this company was back in 2018. But to refresh, on the second slide, this company makes all sorts of fiber lasers and photonic solutions for a wide range of industrial, automotive, aerospace, and medical applications, as shown by these images. And this includes multi-kilowatt scaled power lasers that can precision cut through metal. Going to the third slide, what separates this company from its competition, and this is going back to my college engineering days now, but this company has found a way to improve upon legacy IC lasers by using their own unique method of combining multiple single emitters to increase efficiency in terms of cost per brilliant watt. And today, the company leads the industry by being able to couple roughly 250 watts per 100 micron fiber. And this improvement hasn't been linear, it's been exponential. And if we look at the top right chart on this slide, in terms of dollars per transistor, nLIGHT solutions improve cost efficiency by roughly a factor of 10 every decade. And this in turn helps to create more and more applications, which further expands the market opportunity. So that's the basic technical explanation. Moving to the next slide, here we can see that China represents a big chunk of the company's revenue, and the company saw growth from industrial customers in Q2. Given that manufacturing PMIs have continued to come in strong since, there's a good chance Q3 and Q4 revenues are going to continue to come in strong. Now, going through management commentary, I have to say it's very encouraging, especially with regards to China. And the CEO believes that the primary end driver for this strength has been China's investment ramp to support 5G, including networks and handsets. The last thing I want to touch on, if we look at the bottom chart, you might be concerned about the negative 21% year-over-year decline in microfabs. But looking ahead, this is not a worry, because despite the year-over-year decline, microfab revenue actually grew sequentially for the first time in over a year. First of all, the company said that the ongoing microfab demand in Q3 from China has been stronger than typical. And going forward, they are encouraged by what they're seeing from their key global customers with record contribution from Chinese manufacturing. And so they're expecting to see growth recover for that segment. Maybe not as strong as past cycles, but at a minimum, they're expecting growth to flip back to positive. And when we get to 2021, that's when we'll have easy comparisons. Now, taking a look at the chart of LASR on the next slide, we can see the stock hasn't done anything since May. And this is what I mean when I say construction and industrial stocks have run, but some of these industrial semis have gotten ignored. So back in May, this stock managed to break the old resistance level of $20. And so that $20 level has now become support. And there's been a lot of accumulation since. And here's a little technical analysis trick I learned from my mentor who used to manage an equities desk at Nomura. And we can use this trick when analyzing small and mid caps. Here's the trick. When it comes to small cap stocks, the reason why it's easy to spot accumulation patterns, which are in the tight range like this one. So as a simplified example, let's pretend for a moment we're an investment bank or a broker, although these days it's all algorithms. Now, if we get a huge buy order that comes in from a family office or a hedge fund for, say, $200 million worth of LASR. Now, if we're talking about Amazon or Facebook stock, then a $200 million order is small potatoes. But for LASR, this is huge because the market cap is only 900 million. And the stock is not highly traded. And because the institutional clients tend to be very forward-looking, these orders tend to come in long before the next catalyst. So as market makers, if we were to execute and hedge this entire order right away, like just at market, that's going to send the shares spiking. And then our client is not going to be happy because we didn't execute at a favorable average price. And so instead, what we'd rather do is buy a little bit each day over the course of several weeks so that we can keep the shares within a tight range and favorable price. And because this is a less traded small cap, there's very little chance someone else is going to come in and mess up the range we created as there's no catalyst. And then after we finish getting filled, that's when we allow the stock to break out. Now, coming back to this VOP chart that I shared, it looks to me like there's some large orders being executed here, and the longest VOP bars are falling between $22 and $24. And so I think someone is trying to get in at an average price of 23. And these are large orders because it's taking several months. Stocks don't normally behave like this, getting stuck in a tight range for a long time. So whoever is putting this order has shown their hand. But we're also coming up to a catalyst here, which is earnings. So maybe we finally have a breakout. So the takeaway here, I guess, is when we look at chart patterns like rectangles and flags, sometimes it's easy to forget there are real people, or rather real computers, that are behind these patterns in small and mid caps.
Yeah, on the technical side, I agree. The thing about the small caps and the mid cap space is that there's simply not enough supply of shares out there to absorb when the large institutional players step in to take a sizable position based on their fund balances. And if you're not positioned in these names in advance, that's when you miss the move, because when they step in, you get moves like this one we saw in May, where 20% moves can happen in a heartbeat, and then you're chasing at that point. So that's not the problem with big caps, where you can basically scale in or just wait for technical breakouts and then step in. But small caps and mid caps, a news-driven market can have a significant impact. So I agree with all of that technical view. This is my favorite chart of your slide deck here on the fundamental side. This is this clear indication. Basically, it's telling me that the second quarter 2020 was a breakout quarter from this company, because you have to go all the way back to the second quarter of 2018, where the revenues had stalled around $52 million, and then slightly, came down basically for good 2 years. Not much was happening, and then boom, we had a massive breakout. And then with the PMIs rising and the industrial semi sector generally doing strong. Also, by the way, talking about industrial semi, NXPI, which has a huge exposure to the auto cycle, and it's a semi, it's breaking out this morning after reporting a good quarter last night. And so anyways, so this is a breakout quarter, and I would expect more sequential uptick from here. The $52 million run rate could get up to 55 to 60 million. And similarly, we're here by when we break it down by its end market. And what does that mean? That means the setup is there for a technical breakout in Enlight, driven by both multiple expansion and earnings expansion, and stock should get all the way to $30 per share. So very nice technical view here, a very nice fundamental color. I may jump into this one myself. Good stuff. By the way, I think we covered this one time in our quarterly outlook. I'm trying to remember now. It was in the key debate section a while ago, a year ago or something, or maybe a year and a half ago. I have to look back, but this was covered previously. Anyways, fantastic stuff, guys. Thank you very much for joining. We'll stop over here. We'll see you in the chat room shortly.